Do you wonder whether you are at high risk for an IRS audit? Hello, I'm Amanda Hahn and I'm a Managing Director with Keystone CPA. And I'm joined here by my partner Matt.
Hi everyone, I'm Matt McFarland. I'm also a Director at Keystone CPA. Welcome and thank you for joining us on this educational video series. In this segment of our video series, we're going to share with you 4 red flag audit areas the IRS doesn't want you to know about. Additionally, we will talk about the new IRS plan of attack and changes that are going on at the IRS right now.
Then we will share 5 techniques you must do to audit-proof your tax return. For the past several years, when the economy was doing well, audits have actually decreased because the government was able to receive a good stream of revenue based on the prosperity of our nation. However, as you may have guessed, with the current economic conditions, the government is also scrambling for money as well. Since income taxes is the main source of revenue for our government, there are a lot of changes going on in the Treasury Department to ramp up efforts to collect additional tax revenue. Recently, news broke that Treasury Secretary Tim Geithner is pushing for an additional $332 million to go to new IRS enforcement efforts.
Yeah, the additional money will go towards hiring close to 1,000 more IRS auditors as well as increased headcount for collections. And many of the states are doing the same exact thing to increase auditing efforts on their ends. California, which most of you know is in some serious financial trouble, has also significantly increased headcount in order to enforce tax collections.
And I can say that I experienced this firsthand since 2 of my relatives recently joined the California Franchise Tax Board as auditors.
That's right.
So the question is, will you be audited by the IRS? Here's a piece of information that most CPAs do not tell their clients, and we will share that with you here. And that is, the U.S. court system's motto of innocent until proven guilty does not apply when it comes to tax law. It is imperative that you understand the IRS and the tax law do not adopt that same theory. Rather, it could be concluded that under the IRS, a taxpayer is actually guilty until proven innocent.
This is an extremely important concept here. If you remember anything from this video series, remember this: that taxpayers need to prove their position in order to win the battle with the IRS. What is stated in the tax law is that the burden of proof lies with the taxpayer. So what this means and what this is saying is that the IRS questions one of your transactions, you need to prove your position in order to prevail. If you can't support your position, then the IRS will automatically prevail because, again, the burden of proof is on you as the taxpayer. The IRS doesn't need to prove that they're right.
So now let's talk about a real-life example. A taxpayer came to us after he was audited by the IRS for taking the real estate professional status deduction. For those of you who are not familiar, the real estate professional status is a loophole that allows a taxpayer who invests in real estate to claim some big deductions. Of course, there are rules that specifically determine who is and who isn't a real estate professional for this benefit. Now back to the story. When the IRS came knocking, this taxpayer did not have any documentation to support his position as a real estate professional. And in his own defense, he told the IRS agent, "I use TurboTax to do my tax return. I don't know the rules because I'm not a CPA. So this is not my fault and you shouldn't penalize me for it." Well, if you guessed right, his plea of ignorance did not work with the IRS. And he lost some pretty big tax benefits just because he didn't have documentation to support his position. Furthermore, the IRS assessed him some big penalties and interest on top of that.
Those were some big penalties. Now let's shift gears to talk about some of the top issues that the IRS is focusing their audit efforts on right now. We're going to be speaking about some of the areas where the IRS agents are being trained to specifically focus on in the coming years. And it's always good to know what these areas of interest are so that we can plan for and document ahead of time in case of a potential audit. Now, a current IRS target area is actually meals and entertainment deductions. The IRS has realized that a lot of small to mid-sized companies overstate their meals and entertainment deductions on their tax returns every year. So here's the technical rule. A meal or entertainment expense can only be claimed if business occurs immediately before, during, or after the meal. So some of you may think, well, how's the IRS going to prove that I didn't discuss business during lunch? Well, remember that the law states the burden of proof is on you as the taxpayer. So in other words, the IRS, again, doesn't have to prove anything. It's up to you to prove that business occurred in order for you to take the expense. Now, one way to do this is to obtain the business card of the person you met with. You can further substantiate the meals and entertainment deduction by just jotting down a couple words regarding what business you discussed during lunch. And if your business is an industry that deals and involves a lot of entertaining and eating out, make sure you have sufficient documentation to support your deduction. And another good way to do this is to have your company create a policy regarding meals and entertainment. Just state in the policy that the company will only reimburse meals and entertainment expenses if business occurred before, during, or after the meal. And we've seen situations where the IRS looks very favorably upon policies such as these.
Another area that IRS agents love to dig into is individuals or businesses with big unexplained expenses. Examples of these expenses are commonly called